Welcome to Commercial Real Estate Now. I'm your host, Carly Iacono. Today, I am very pleased to be joined by Josh Simon, Vice President of EBI Consulting. Josh, welcome to the show. How are you today?
Excellent, Carly. Thanks for having me. Great to be here.
Really excited you could join. We're going to be talking about everything due diligence related with a core focus on two of the most important elements of property due diligence, and that is the Phase 1 ESA inspection and the Property Condition Report, or PCA report. So before we dive into the nitty-gritty of what investors need to look for and how to really interpret these reports, why don't you start by telling us a little bit about EBI?
Great. EBI is a national engineering and environmental firm. We specialize in physical due diligence, property condition assessments, environmental site assessments, and many other engineering and environmental-based services. Can range from MEP, indoor air quality, in envelope analysis, those type of services for purchases, financing.
Development probably too, right?
Development as well.
Yeah, that's what I figured. So I think of due diligence kind of twofold. We have the groups of clients who say, I'm sure everything's fine. I'm going to check the box. Probably not even read the reports. If all's good and the lender says it's okay, we put it in the file and we move on. And then we have the clients that really dive in and look at every line, probably call you with a million questions, right? And want to understand and question everything. I think really you want to be somewhere in between. You want to have an understanding and depth of knowledge of the report to where you know what you're buying, right? You really want to make sure that everything is clear to you, but you also need to trust your professionals, and who you choose matters, right? I don't have to tell you that in terms of the quality of analysis and review of the property that you're getting. So my goal today is to kind of lay out some things for investors to watch for, some basics to understand when they're reviewing all of the information that comes back from a firm like yours. So why don't we start with the Phase 1 or ESA, kind of interchangeable nomenclature there, and tell us when an investor should run one of these reports and kind of what the overall structure looks like.
Okay. So the environmental Phase 1 is a way for a buyer or a lender to review environmental risk. So it's an environmental assessment to protect any environmental concerns that may occur at the property that you're either buying or financing. So it depends on the stakeholder, what side. It could be a lender side that we represent, could be owner side that's buying the property, could be a developer that's buying a site. So the Phase 1 is really for, I would say downside risk protection or innocent, buyer protection. That's really the crux of the environmental, and that risk ends up being fiscal, financial risk. It ends up being, the liability related to indoor air quality potentially. So there's, a litany of risk factors, legal, environmental, health concerns.
Can you define quickly the innocent buyer protections? Because I know there's some statutes in New Jersey, just because I happen to be looking at this recently. I'm sure that in other states as well. But what does the innocent buyer provision mean? Yeah,
well, I would say the Phase 1 rolls up to the CERCLA federal law protection, which under, CERCLA law, there's also the all appropriate inquiry, and that you have to, take a standard of care when you're buying a property or investing in a property or lending on a property. And by doing the Phase 1, that is the sort of standard of care.
Okay, interesting. And if something is uncovered, you then have the option as a buyer, obviously, to move forward, to not, to remediate based on the severity. So talk to me about some of the most common things that are uncovered during a Phase 1 report.
So I would say that the concerns generally are asset types, right? Dry cleaners,
One of the big ones.
auto repair shops, certainly manufacturing, industrial processes. Those kind of are the usual asset types, whether it be historical usage in those categories or current use because of the, chemicals that they've used or the petroleum-based products that will be concerns, environmental concerns.
And correct me if I'm wrong, but I believe there are scenarios where it was none of those historical uses, and there are still environmental concerns due to groundwater or surrounding properties. So we always advise clients that even if it's been a fast food restaurant from the dawn of time or a daycare, right, even more stringent,
Sure,
you still should do a phase 1 report to make sure that there's nothing coming up as a potential concern historically or from a surrounding property. Is there a scenario where you don't think a phase 1 is necessary?
No. No.
I thought that might be your answer.
Yeah, never.
And that's
never.
not just self-serving,
So,
right?
I would always sort of, if I put myself in the position as an investor and my money was on the line, I don't know how anybody would not do a phase 1 or a property condition assessment or a survey when they're buying a property that's $1 million, few million, tens of millions, hundreds of millions of dollars. And I've had clients that haven't.
Mm-hmm.
And, I've had clients that, the seller provided a report.
That was my next question.
There's conflict of interest. There's that term. I just don't know how, if you're putting up millions of dollars, investing millions of dollars, whether it's your money or somebody else's money, that you would ever rely on,
somebody else's report,
whether it be the seller's report or many clients actually say, they don't do it and they just allow the bank to do it. But the reality is you're buying the property, you're taking title, you're liable for it. You should be doing the phase 1 and then providing reliance to the lender, not the other way around, not the lender doing the phase 1 for their own protection and them not even providing you reliance as the buyer, which happens more frequently than you might think.
And what are some of the protections that would be offered to a buyer? So let's just kind of run through a scenario. You have a phase 1 that comes back clean, perhaps, and then there's an issue down the line. Are you really protected against any future claims if you have a phase 1 certified to your buying entity? What is the level of protection?
I mean, this is a litigious society, so your liability protection is better that you've done the standard of care, the phase 1 on a purchase or a financing of a property. Mm-hmm. Whether you win a lawsuit or don't win a lawsuit,
right?
I can't.
But you have the data. You have something to point to.
You definitely have something to point to. That is the standard of care. That's
it's a good way to put
standard of care.
Yeah.
That everybody who's buying a property or financing a property should be doing. And EBI, we are approved by so many lenders across America that there's a point of distinction when you're using a firm like ours because, if you're buying a property, we're able to provide reliance to many lenders. Whatever lender you end up going to, we're approved by many of them. So there's that sort of point of distinction and efficiency. You don't have to do 2 reports.
Right.
Because we're approved by most of the lenders.
You may not know the answer to this, but do you have any idea what percentage of engineering companies have national approval by mainstream lenders? Is that a lot? Is it a little? I'm sure it's hard to get. And that was a curveball. So if you don't know, it's okay.
I'd love to be in a business where, we had a monopoly, but unfortunately we don't. So there's definitely national firms, regional firms, and local firms that, work with buyers and lenders, across America. On a national scale, I come across, a handful.
Right.
There's 5 to 10, I would say, national firms like us that we compete with that are sort of pervasive in the market.
That's not, it probably feels like no, of course they don't exist. That probably feels like a lot to you, but that's a pretty small number nationally. So it just kind of points to how rigorous the business is and how difficult it is to scale and get that recognition from lenders and buyers. So good job.
It's definitely thank you. Thank you.
So let's switch gears and talk a little bit about recs. Now, when you get a report back, most buyers that we know skip immediately to the summary page and say, okay, what are the recs on the property? What's the snapshot here? And if there's no recs, then great, I'm good to go, which is hopefully true. Talk to me about the different types of recs that you find and which ones would pose kind of more concern than others.
It's a good question. I mean, recs are recognized environmental concerns. Generally, they're based on, some level of scrutiny that occurs off the phase one, right? So we'll do the phase one. It's a site assessment. It's historical regulatory review. And then based on that data, we would have some potential either recs and or recommendations. A rec and a recommendation, not the same.
Oh, good. Important distinction there. Okay.
That's one that, kind of gets confused in the marketplace. So when we do a phase one, we don't have to put recommendations, but a recognized environmental concern, we have to list.
Okay.
So just because there's a recognized environmental concern, doesn't mean we have to put phase two in the summary page as like recommendations.
Got it.
So phase one doesn't require recommendations put in.
Interesting.
They do require recs, which is that recognized environmental concern. The rec, and I have the actual definition that I brought. So it's the presence of hazardous substance or petroleum products, right, on the subject property, due to a release to the environment or releases, underground storage tanks, reported releases that are on file with regulatory agencies, above ground tanks that might be leaking. Second part of the definition of a rec is likely presence of hazardous substances or petroleum products. And again, the likely release to the environment. So the third is the presence of hazardous substance of petroleum under conditions that pose material threat of future releases to the environment. So again, it's hazardous materials, petroleum-based products that may or may not have caused impact to soil, groundwater.
And what's the difference between a historic rec and I guess a current or future rec?
Or a controlled rec?
There you go.
Like a C rec or an H rec?
Exactly what I meant. Right. Yes.
So both of those are kind of like those are actually better than just a straight rec.
Okay.
Right? So
Walk me through the difference.
Controlled rec is that it's kind of been addressed, and to some degree of satisfaction by some regulatory authority. That's kind of the controlled rec. And again, it's related to hazardous material or petroleum-based products. The H rec, again, is also something that's kind of been addressed by regulatory agencies and authorities. So, those are probably on a scale of, higher risk.
Right.
Those are lower risk than, a straight rec that have no controls, or, there's some regulatory agency from a historical standpoint that got comfortable with it.
So my takeaway from that is just seeing a rec on your phase one report does not completely invalidate the acquisition, right? It could be something that was historic. You just need to weigh the risk of those individual recs, right? Talk to your consultant, talk to your attorney, figure out what your future risk is. But having a historic rec, for example, kind of lower on the risk spectrum is not the same as the other types of rec. So you need to treat it differently and really assess the risk and not just say, well, okay, it's not.
No, agreed.
Right.
I mean, I think you hit the nail on the head in terms of like assessing the risk.
Mm-hmm.
I mean, that's what EBI does. That's what we do. We're assessing the risk on behalf of our clients and looking at it holistically to say, hey, this is a concern. You should address this risk. Everything, there's solutions for everything.
That's good to hear.
And our goal
just
is
how much money, probably, right?
Correct.
Yeah. Okay.
To find the solutions.
Right.
And to really uncover all the data that's available. right? Like the data points, are really instrumental. And many times, the data, we're private investigators trying to find the data, right? Whether the seller's not providing it or going to the, DEP or DEC and kind of searching for prior, reports or history that, is either there or not there. But the more data points, the better we're informed, the more we're able to address the risk.
Interesting.
And the risk, everybody has different risk spectrum, right? So an insurance company is very different than a debt fund.
Right.
Right.
True.
And family office may be very different than a REIT, on how they view risk.
Right. And what they're willing to tolerate.
Everybody's different.
What's a concern, just like investing, right? It's just one more piece on the risk spectrum. How often do phase 1 reports lead to phase 2 investigations? And what are some of the common triggers that would escalate to a phase 2?
So percentage-wise, it's kind of hard to say from a percentage standpoint. I remember a client once saying to me, "Hey, I'll give you phase 1 work, but don't recommend the phase 2." Right? Like
telling you how to do your job.
Yeah,
that's always fun.
And I said, "Well, that's great, but let's make sure there's no former dry cleaner, no auto repair, no industrial processes, and percentage will be better that we don't have any wrecks."
Right.
But when you are talking specifically about assets that have had those type of concerns, petroleum, underground tanks, above ground tanks, solvents, PCE, TCE, paper and pulp manufacturing,
there's probably going to be a wreck.
I mean, now whether it goes to a phase 2, it really depends on what was done prior.
Okay.
What we know about the site.
And the cleanup, right?
What we know about the adjacent sites. Mm-hmm. Yeah, and the files for the cleanup.
Yeah. So use, any historical use, historical issues, something that maybe wasn't closed, all those things don't necessarily have to, but they could trigger a phase 2. Correct. And then when you're doing the phase 2, I'm sure or know that the process differs based on what you're trying to discover, right? So monitoring, sampling, drilling, what does the suite of, tools look like for the phase 2 investigation? How involved do they get?
Phase 2 tends to be not overly cumbersome or detailed.
Okay.
So it's widely used in the industry. Nobody wants to spend more money. Nobody wants to, poke holes to find, issues. But I would say the phase 2 is really, generally corings that are, the size of a dime or a quarter in areas of impact. And generally we go down with a probe and look for, pull some soil and or try to reach groundwater that, if it's, obtainable, and then send it to a lab and have it analyzed for,
whatever you're looking for.
Yeah, whatever's there in terms of,
you just made levels. That sound a lot less scary than I think most investors react when they hear a phase 2 is being recommended. I mean, it's all out like, what normally?
Their costs. So, the costs are not hundreds of dollars, they're thousands of dollars. So, the ranges could be, it used to be, range from, 6,000, to 12,000, 4 borings, 8 borings. But again, it depends on the property, depends on the area of impact. And, generally, you do a few borings, you analyze it, and, I would also say like different states, having good representation, whether a firm like EBI or, good environmental counsel is really important. Every state's a little different. In terms of reporting standards, due diligence is different than a property owner who's doing phase 2. So there's nuances to, how to approach a purchase sale and who's going to do that work and get the results, and pay for the results and whatever those results may be, like, would there be reporting or not reporting? So.
And what's the time frame typically to complete a phase 2 from the time it's ordered? Is it a huge variation depending on the individual property, or is there like kind of a set framework for the time frame?
No, I would say, most of the reports that we're doing, whether it be property condition, environmental, and or phase 2 are generally, I'd say 2 to 4 weeks.
Interesting. Okay.
Yeah.
In my mind, the
our
phase 2
standard
is
is 15
longer.
business days.
Okay.
Across the country.
Reasonable. Yeah. Nice.
I think it's reasonable. It's I think a little, more reasonable than maybe appraisal.
Right.
They tend to be a little longer than our 3-week turns, but
depends on the state on that one. It's crazy how long they can take. Okay, last thing before we move on from phase 1s, how do lenders look at phase 1s, and what should borrowers expect when talking to their lender about the phase 1 report?
Lenders are generally, public institutions. Their risk tolerance is generally higher than, let's say, somebody whose risk tolerance is lower. I mean, for lack of a better word. I think lenders are, risk adverse by nature, right? They're protecting the bank. That's their primary responsibility, and the capital that the bank has. So I think, the lenders will look at the phase 1. They'll all do phase 1s on any financing, whether it be acquisition or refinancing. I don't know. We don't treat it, equity or debt.
You don't treat it any
differently, really.
Right. Okay.
I don't really, we try to work, everybody, this is a deal-centric industry. Everybody's trying to do deals. We're working with the parties to try to get the deal done. So I'm not sure, the question, like
is there
how
a lot
best
of
to address your question.
Pushback if there are wrecks found? I guess, again, lender is coming from a place of protecting capital and risk aversion. So I would imagine that's sometimes a more difficult conversation if there's financing involved, because you have now one more entity assigning risk to a property which may have a lower tolerance than the buyer themselves.
That's exactly
could be the issue.
Point. Their risk tolerance. It's been hard to find deals over the last few years, right? Between the expenses and everything, right? So many equity when they find a deal where they like the basis, they want to jump in. They don't really want anybody blocking their deal. So maybe their risk, meter, goes down.
Right.
And, the buck stops with the lender.
Right.
And us working with lenders and saying, hey, there's risk here.
Right.
And you have to address the risk.
Like it or not.
And it's for their own benefit, really.
Exactly.
At the end of the day, almost protecting them from themselves.
Yes.
In many ways. Like we had a buyer maybe 2 years ago, and, the market, was distressed, right? Coming out of COVID and the high interest rate environment. Family office found a grocery anchor deal in Pennsylvania. They hadn't bought anything in 5 to 7 years. They found this great, beautiful grocery anchored shopping center. We came in, we did a phase 1. We had a wreck. So beautiful parking lot, no gas station in the parking lot, except historically there was a gas station in the parking lot.
Got it. Okay.
So in plain eye, it's a great property.
Right.
But underneath the parking lot was an old gas station. The question came because there was information on prior reports, like where the tanks
closed, right? Were they removed?
They weren't removed. They
weren't
closed.
On deals.
Just there was no documentation that gave us comfort to say closed,
there's nothing there.
Removed, gone.
Right.
So we brought up this wreck, this concern, and the gentleman who's buying the property blew a gasket. He was like, "You're ruining my deal." Right. This is you're killing my deal.
Right.
And I'm like, well, we can do a phase 2. He's like, there's absolutely not. The seller will never allow a phase 2. I'm like, well, how about GPR? Non-invasive.
Right.
We scanning, ground penetrating radar. We scan, see if the tanks are there.
Right. That was a great suggestion.
Right.
Next
Non-invasive, no poking holes.
Right. How'd that go?
He goes, absolutely not. Seller won't allow us. I'm like, I don't know what to tell you. Yeah, I mean,
So what happened? They walked away?
they walked away.
No.
Yeah.
Oh, stories like that kill me.
So
'Cause
I
feel
saw
like
him
it
a
could've
couple
gone-
years later at ICSC,
Okay.
and he was fine. He'd come down, and he said, and
I mean, he did hire you to find these exact issues. So
but the
that's
balance
where
of
it's funny,
risk
right?
mitigation and protecting him from,
Right.
from
Making an issue of the
risk
deal.
versus him wanting to do the deal,
Yeah.
internally for him,
Right.
he had to balance that. In the short term, he wasn't happy. In the
Right.
long term, maybe he'll come back as a client. I'm not sure. He said he would allow us to do some more work going forward.
Okay.
But
There's
I
hope.
haven't heard from him in a little while, so
It's hard to protect people from themselves, like you said. But I thought the radar was the perfect example. Non-invasive. It's not crazy expensive. I think it's definitely worth it. And then maybe,
perfect solution.
right, you would have seen no tanks.
No
and
tanks.
all could have gone on their way.
Then he could have said, "Hey, I'll take that risk."
Right. Because there were
the
no
tanks
tanks.
are gone.
We're fine. Right.
Yeah, the tanks were from
Yeah.
30, 40 years ago. The gas station. Right?
I think that's a takeaway and a good segue into our PCA conversation. There are solutions, and a lot of times it may not be what you want to hear, but it's a matter of working through whatever it is that you find. And that's really the underlying nature of real estate in general, right? No deal is absolutely perfect. It's just, what do you want to spend time on and work through to protect your value? And what do you want to walk away from? And that's the nature of every deal. But if you don't have the baseline information about what you're buying or what you're dealing with, how can you ever make the good decisions about what you want to work through when you don't even know what's there? So to me, I mean, the conversation we're having today is so obvious, right? You've got to run these reports. You need to understand them. You need to read them. And then you make informed decisions. Maybe you accept the risk. Maybe you don't. Maybe you remediate. Maybe you don't. There are options. But until you know, what are you doing?
Sure.
Exactly. So,
Sure. And we've seen that on the bank side.
Right.
They'll like analyze it and say, this is a business risk. It's really low leverage. There were some concerns, maybe HREC, maybe CREC, like some concern that arose, adjacent properties. And the bank determined great sponsor,
they were fine with it.
low leverage. We're going
Right.
to treat this as a business risk. This is not going to blow up the deal and we
Right.
can get this done.
So it's fine. But that's an informed decision.
It's really, the informed decision is like having all the data, getting
Right.
as much data as possible. I mean, data is power.
Mhm.
Analyzing that data, having great partners, talk through it, work through it, discuss it, bring in folks like yourself, bring in, environmental attorneys, whatever you have to do to properly analyze and make an informed decision.
That's
I
exactly
think
it.
that's the way to go.
So let's move to the second big pillar of property level due diligence, and that is the PCA report, or property condition assessment. Give us a general overview of what's covered and when those inspections are relevant.
Okay, yeah. Property condition assessments, basically, again, like the phase one, they fall under like a standard guideline, which is the ASTM. That's a governing body for these type of reports. The property condition assessment is basically, less about the environmental side and really kind of the engineering side. It's an assessment. And generally, we were sending in either a type of engineer or an architect, somebody that's a generalist that will look at the property on whole to assess, the structure, the envelope, fire, life safety, ADA, those kind of things, the exterior, parking lot, sidewalks.
So are you picking up violations in addition to kind of gauging the useful life of major systems, or are you not looking at like code violations or things like that in a PCA?
So we violations would get picked up, but we don't do code analysis.
Okay, that's
right.
different.
So violations would get picked up, and then we do the checklist for ADA compliance, fire, life safety as well.
I always explain it to new clients like a home inspection for your commercial property.
Exactly.
Which seems to translate pretty easily, right?
Exactly what it is. Exactly what it is. It's not a exact science, right?
Mm-hmm.
Because at the end of the day, it's a generalist that's covering all the systems of a building.
Yeah.
And if you think about it, there are specialists for each system of a building. So to have a generalist who's an expert at MEP, that's really not the purpose, of the property condition. It's very much a quicker type of assessment by kind of a generalist that's covering all the major components, efficiently to give you some guidance. Again, it's, right? Because if you really wanted more of like an exact way to cover a building, on a purchase, you would have a specialist for every component of the building.
Right,
which
like
would just
HVAC and roof and all the individual systems.
There's roofers
right?
that do roof all day long.
Right.
There's system MEP folks that do MEP work all day long.
Yep.
They're system experts.
Parking lot.
ADA is its own industry, right? Like it's very detailed. When you do like a level 4 ADA analysis, I mean, they're coming out with exact measurements with, railings and height of toilets and, stuff of that nature. So,
But that's not practical, right? To bring all
Correct.
these different
Exactly.
individuals,
Thank
the
you.
cost would be
Perfect.
insane, the timeline, it just, it's not practical. So that's why we have PCA reports, right? To give us the
exactly.
indication
Thank you.
and
Yep.
what we need to focus on. So what are some of the components that come back with, I guess, concerns, or where do people typically focus on a PCA report, or where are the items that are the most issue typically?
It's a good question. I would say, so they're like immediate reserves, which is the kind of like short term 0 to 1. It's kind of material issue, life safety. And when those, when there's cost in the immediates, I would say that's like the highest level of like scrutiny, right? For the buyer, for presenting it back to the seller, for the lender, if you're, utilizing the PCA for the lender. So that's kind of the, sort of main, when looking at a PCA, that immediates are really kind of the key focus. And, we've seen immediates, range. I've seen immediates where it just said $500, but really the 500 was to get a specialist to come in to look at
That's
something.
kind of misleading, but okay.
Well,
Yeah.
correct. But this is why people have to read the reports
Okay.
versus go right to the summary page and, hey.
They're long, though. I mean, come on, they're long reports. I don't think most people are reading them. No, I'm kidding. Everyone should read them. Yes, they should not just go to the summary report.
Well, at least look at the pictures.
Yeah, at least
and
look
the
at
notes.
the pictures. Yeah, exactly.
Or the table, the reserve table.
There you
right?
go.
Because then you can see
There
the
you go.
cost. It's kind of broken down, sort of the meat and potatoes when you look at the reserve table
Right.
and see the cost and how it's broken down.
How are the costs estimated for replacement of systems or immediate repair costs? Are, geographic considerations taken into account? Because obviously the cost of materials is higher in the Northeast than potentially the Southeast. Useful life, is that taken into consideration, again, when you look at weather patterns and things like that? How is all of this calculated based on where the property is located?
Exactly.
Okay.
No. So the replacement is sort of averages.
Okay.
There are, many times we're using like our own internal costs from work that we've done throughout the years. We've been around almost 40 years. So we have cost analysis on asset types, locations, geographic locations. There's also like RS means, Marshall Swift that factor geographically as well as, asset types. So, we're utilizing that information to come up with replacement costs. And, quite frankly, the generalists are going out and looking at the estimated useful life and coming up with, hey, where is it in sort of its estimated useful life, and applying, the replacement number against that.
Is wear and tear based on weather patterns a consideration for estimated useful life? I mean, obviously the sun is much stronger in Arizona than it is in Vermont.
Absolutely.
So all of that is factored in as well.
Yeah. I mean, property types have their own nuances and locations have their own nuances, right? A property in Florida is a lot different than, a property in St. Louis, right? And weather patterns, more and more firms, more institutional, I'd say, and foreign investors, whether it be pensions and stuff, they're doing climate risk, like resiliency analysis. Some of the insurance companies also look at, resiliency studies, climate risk assessments, and that has an effect. on the property and the risk. Right. Like, you have the wind issues in the Midwest. You have the salt water in, the Southeast. Houston and Texas have their own, kind of issues. So
that is factored in.
Definitely.
Which is good.
And then you have, snow up north, right? Like,
right. What about cost inflation? Is there a certain amount that these cost estimates are increased every year, or you're relying on these other agencies, I guess, who put together prognosis or estimates of costs for various systems and they're factoring in the increase? So I guess the question is, are you... No, that's a good point. Again, these are averages that we're using in PCAs, right? That, many times you could get a local specialist and the cost will vary. Okay. Good or bad? Higher or lower?
Higher or lower.
Right. Okay.
Higher or lower. And those are conversations that we have all the time.
Right. So if something comes back that is really impacting the value of the property or maybe going to lead to a retrade on price, it could be that it makes sense to get a local specialist to weigh in or give another quote for XYZ system.
Absolutely.
Yeah, that makes sense.
Absolutely. And it gives credence to our assessors and reviewers to say, hey, here's somebody local knowledge, local costs, right? Because the costs vary amongst the country, and assess and then have a discussion. Because, I remember having one on roof replacement, right? Where, we were going back and forth and, we did this report and, kind of came up with like $8 a square foot on roof replacement. And, they came back and they said it's $4. They were trying to get their loan. So they wanted it at $4, we were at $8, and we had this whole kind of conversation about where we should net out. They ended up having a national roof contract at $4 a foot.
Okay.
And so, it gave our engineers and architects kind of comfort, say, okay, they negotiated great, cost on roof.
Right. So they were able to work that in to the estimate. How often are you looking at owners' historical maintenance records? And do you place credence in these records? And does that change the remaining useful life? Or are you just inspecting things on site?
Sounds like you've had that come up.
I feel like I've had everything come up through the years. Okay. So, I've got some more good questions for you like that personal experience.
Yeah. So, we actually, on the property condition, what I like to disseminate to clients is we offer really 3 levels of scope.
Okay.
So there's the ASTM standard that's widely used by the banks for financing. They are looking for life safety material issue, right? At the bank side, it's kind of like, I don't want to say check the box, but it's just another report that the lender has to put in, the appraisal, the survey,
right.
Zoning,
so they're just ruling out big things on that report.
Big things, right? Yeah. And, they're doing loan underwriting. That's the purpose.
Right.
Is for loan underwriting. That's the purpose of that report. We also offer an equity level property condition by senior assessors with 20 plus years experience that will go through similar to the debt level or the standard, but they will get into maintenance record review. Okay. So generally, from a time standpoint, the efficiency and the cost for debt level is not the same as an equity level. So the equity level is a deeper dive by somebody more senior, more experienced for the purpose of your acquisition that may utilize it for capital planning over the life of their hold. And we'll get into maintenance record reviews and we'll get into more granularity, which will be more time on site by somebody more experienced.
And more expensive, probably.
More expensive.
But more detailed.
More detailed.
Right.
But it has to be, the right fit for the right deal, for the right property, for the right sponsor who wants to say, hey,
I'm doing a deep dive.
A little deeper dive.
Yeah.
A little deeper. And the third level would be specialists for all the components.
Oh, got it. Like we talked about at the beginning.
Not even do a PCA and do specialists for every component.
Wow.
I'll have my roofer come out. I'll have a system person go out. ADA, maybe, depends on the asset class, recommended because there's liability, in ADA, and it could be very expensive. Parking garages is his own specialty, could be very expensive to repair parking garages. So again, nuances, right? There was an insurance company in New York, I won't get into names, but they spent $100,000 when they were buying a skyscraper in New York.
Okay. Huge project. I mean, that's material money, but obviously.
Hundreds of thousands of dollars.
Yeah.
I'm not talking about a few $1,000s.
Right, right.
Hundreds of $1,000s prior to taking title.
Got it.
Right? Because they had people rappelling off the side of the building to look at the facade.
Right.
Right? They were doing all MEP on every purchase. They were doing elevator on specialists, on every purchase.
Makes more sense at that scale, right? You have a huge equity check going in, so you want to protect it and make sure you understand your capital reserves, right? I mean, there's a lot more room for extreme cost variations if you're talking about a New York skyscraper versus, Wendy's.
You say it makes more sense.
You don't think it made sense?
I do. If it was my money, absolutely.
Yeah.
But do I have clients that buy, buildings 100 million plus?
Oh, and not do it.
And not do it?
Yes, I could see that too.
All the time.
Right.
All the time. And it's perplexing
right.
because you're like, how?
Right. They're like, no, it's fine.
You're not going to do a phase one?
It's fine. Is there?
It's fine. The building's fine.
It looks great. Look at it. It's so pretty, right?
Yeah.
It's so nice.
Here's one that came up years ago, actually by this same insurance company. They had an in-house engineer, and he threw something out at me where it really was profound. He said, a building that stood the test of time over 100 years, there's less risk probably than new construction.
That's fascinating.
I was like, really? Why?
Just the quality of construction?
Construction defects.
Yeah. Yeah.
Now, a lot of things are under warranty.
Yeah, that's interesting.
But it really...
You would know about them.
Yeah.
After 100 years.
100 years. It would come out over time.
That's fascinating.
New construction, you wouldn't know until it comes out.
Right.
And if you took title and didn't do, proper DD,
right,
maybe you'd be under warranty, maybe not, right? Like, it depends on,
Yeah.
So it was kind of profound at the time.
Yeah.
And still is profound because it's kind of like,
Yeah, you wouldn't think that, right?
Exactly.
The baseline would be new construction. I'm going to have a longer useful life, less issues, which probably is true for the most part, but that was a good point for sure. Is there any liability for the PCA inspectors if the remaining useful life is way off? Or if there is, may have had this come up on a deal, perhaps, where it was a new construction project and, we had resold it after, I think there was like 5 or 6 years of ownership. And there was a major problem with the parking lot, which was supposed to have another, I think we were like 12 years of remaining useful life at that point. It ended up having like 2 years. So the next buyer who had done a PCA report had significant concerns that the remaining useful life was not what was in the report. It was a national company, not EBI. Is there a liability from the inspector, or what should that buyer do in that scenario where just the expectations did not match what was put forth?
Good question. It's a good question. You listen, you get what you pay for, right? In essence. So you have to have a good partner, right? You have to trust that partner. We don't cover 100% of every nook and cranny of a building and a building property. We're not covering 100%.
Right.
And you don't want to pay for me to cover 100%.
Right, of course.
Under DD on a 30-day window. Right?
Or 21.
Or 21 even, right? In New York, it's even
Okay,
quicker.
go on.
New York, it's like, can you go out tomorrow?
Exactly.
We got to go hard in, 5 days.
Exactly.
It's unbelievable. So is there liability? Of course there's liability.
Okay.
This is America.
Right.
Probably the most litigious, country in the world.
Right.
Right. So there's liability in everything we do. And of course we have terms and conditions to protect, CYA, for everything we do.
Yeah.
Right. But the reality is, these are average. Again, we're not covering 100%. Mm-hmm. The ASTM says 10%. Right. There's a big variance between 10% and 100%, on a walkthrough. You're going to cover 100% of the units, and which units are going to say, and who's touring with us, right? So like there's a lot of nuances and variables that come into play. Many times we go on sites where the person who's giving us the tour has no knowledge of the property.
Interesting.
Now, we're trying to do our job as engineers and environmental.
But if you can't get your questions answered, That's a little bit harder.
Nobody with knowledge of the property?
Right.
No chief of engineer, no somebody that, has been dealing with the systems or the envelope or repairs or maintenance?
Mm-hmm. So it would be easier to miss things in that case.
You think?
Yeah, for sure.
So, again, we disseminate questions like the environmental phase 1. There's all appropriate inquiry. We send these questionnaires to our clients, to the property manager, to the brokers, and we get nothing back.
Sorry.
Probably 50% of the time.
Right.
They should be filled out, say
right.
unknown, sign it, dated. That helps with liability protection for everybody.
Right.
And to get the all appropriate inquiry and basically buyer, innocent buyer defense and protection. So, on a PCA, is there liability? Absolutely.
But nothing's 100% or foolproof. So you rely on the reports. You dive in deeper where you have concerns, right, on the front end, and then hope you can trust your third-party providers.
Correct.
Yeah.
But, again, there's so many variables that come into play. Right?
Exactly.
What information do you have available? How much did you spend on it? How much time on site? Who's touring with us? Do we have the plans? You know how many times I ask for the plans? You know how many times I get the plans? Seldom.
Very little. Very
few.
Little. Yeah.
So I was an engineer walking on property or an architect with no plans.
Yeah. Well, I will say, just to make you feel a little better, that was my only example of a significant issue post PCA in countless deals that I've done for a lot of years.
Good.
So
good.
I
and
do the only one I will ever see. So I do think it's a useful report and has led to some renegotiation in cases. It's led to some immediate repairs, changes in reserves. Like there are action items post PCA that clients will take if they actually run the report and read them. So I just brought up that one case because I was curious what your take on it was, but it's very uncommon in my experience. So
yeah, it's uncommon in my experience, but it has come up.
Yeah,
it's come up where there's a disagreement on cost or something's come out, and then listen, just because it's been raised doesn't necessarily mean it's totally accurate too. So like, we've had our engineers look, what happened, and came to a determination together, with the other party to sort of either agree or not agree.
Right.
Or, and so the reports are vital.
Right.
The PCA, the phase 1 are vital in a transaction, whether it's financing, recapitalization, purchase. They're really important. We do a lot of capital needs assessments for co-op boards and condo boards, vital, right, to plan properly, over 10-year period or whatever period you deem appropriate.
Mm-hmm. Are there any changes to technology or building materials that are changing the way PCA reports are done or the way phase 1s are conducted? Anything either maybe from a data technology or from a material perspective that's changing your business?
It's a good question. Listen, AI is definitely going to have an impact on everybody, the way everybody does business, right? So I was on a call this morning and, we were talking about, construction loan monitoring, collecting files, in terms of monitoring like construction for banks. And really what's going to happen is there's going to be platforms and there's going to be files put in and, basically they're going to be, I forgot the term exactly they use, but like almost scrubbed to pull out and extract the important data from the reports on file. That'll be much more efficient for banks to review, construction monitoring reports or plan and cost reviews. So, I think it's exciting.
Just another set of eyes and very thorough eyes, right? If you have AI reading all historical documents and then you have an engineer reviewing the information, it's just another layer.
I think it's great. I think it's going to be, game changing for data and information and power to make decisions based on the data and the information.
So all good, all positive stuff.
I think so. And it's going to create new jobs. Everybody's so scared, right? Like, there was a conversation of like the effect of AI on the electricity and the grid and power. And that's going to create more jobs in those industries for electricity or electricians or, data storage and data centers and stuff of that nature.
Well, I love that you think and see it as a positive influence to your business because it's not going away. So I think the faster we all adapt and integrate it and see the positive sides, the more we win from it and stay ahead. So
Agreed.
Agreed. Any parting thoughts on due diligence in general or anything else about the phase 1 or PCA that you'd like to share before we conclude?
No, I think I would just reiterate, I appreciate you having me on the podcast. Thank you. I would reiterate that, data is very important in third-party DD, physical due diligence, PCA phase 1, any information that could be called on the front end, prior to engagement, ON, broker setup, plans, prior reports, survey. I can't tell you how many times, we work with clients, they don't even know the collateral.
Right.
Was that parcel part of your collateral? I don't know. You have a survey? No.
Yeah, that's cute. We didn't even touch on surveys, but
block
that is
and
another
lot.
big one.
Yeah, the block and lot. Like
that's huge.
There's more addresses. Like what how many addresses are there? So, like data is very important. I would also reiterate, a conflict of interest. When there's a conflict of interest, be leery of that. We've seen many times where there's, people really, working these reports to their own benefit, right? There's really no compliance and, oversight. So it's very, again, for my clients, I'm not a believer of, accepting seller reports or stuff of that nature. So those would be my kind of two. Data, more data is better. Conflict of interest, adhere to that,
Protect yourself, right? Do your own reports, review them, read them, and then act accordingly. It doesn't have to be a deal killer. Yeah, read them. We'll end on that. Read your reports.
Yeah, there
right?
you go.
Excellent.
Read.
Josh, this has been very informative. I really appreciate you coming on the show to share your insights on PCAs and ESA reports, crucial part of the deal process for all of us. So thanks so much for joining us today.
Great. Thanks, Carly. Appreciate it.
To everyone listening, that was this episode of Commercial Real Estate Now. We're so happy you tuned in, and we look forward to seeing you again very soon. Have a great day, everyone.